Good morning, ladies and gentlemen. This is Clue Trading Frank, Monday pre-market AM report as we enter the month of October, approximately 8:37 a.m. And here we go. What we see behind, I'm going to give you a quick macro and a micro picture of what's going on with the markets, so you guys can effectively, you guys and gals can effectively manage your trades. And remember that even in a down market, or an up market, you'll certainly have selected stocks which are going to be up or down regardless of what the market's doing. Stock selectivity is the key. And before I move into the technical part of the picture on this 15-minute, 20-minute video cast, keep in mind that as we enter the month of October, you get the seasonal jitters, the seasonal flu, as I like to call it, which comes about pretty much 80% of the time at around the middle of the month. So as we were talking about very much in detail in Sunday's advanced coaching session for enrolled students, that this particular week is most probably, if the market allows, is going to be the up week, and then we're going to go into a corrective phase starting next week through the third week of October, in my humble opinion. Now, nothing happens in a straight line. You will see some reactive rallies, reflex bounces, and such. But I would say that in general, we should have a corrective action of anywhere around 4% or so, which will feel like the world's falling apart. But all that is doing is resetting some indicators and internals on the market on a larger front, specifically on a daily and weekly basis. So, as you know, I'm always engaged with my members. You get very precise, precision, accurate, strategic, and tactical video casts. You get alerts, charts, and comments, which are extremely, I would say, productive for focused and disciplined traders. So keep in mind that flexibility is the key, and how you manage your trades and your trading portfolio, I would say, completely 110% depends on you. You have to, in my opinion, you have to remain flexible. You cannot take large positions randomly just because something's going up. Or if something's going down on the short side, you have to be fast in taking profits, with a very keen and focused eye behind the scenes, which are the tactical charts that are posted. It's really as simple as that, but the hard part is that we deal in a battleground called the stock market, and when stuff is happening intraday, people tend to lose their heads. Now, that could be on the upside as well on the downside. I do my best, and you all so certainly try your best to manage your emotions and do accordingly. Saying all that, let's take a broad look at the S&P 500 here on this chart. This is your daily chart, and I'm trying to keep this simple. And what you see here is a very pronounced downtrend line. This is the lows from January and February, which I use as a reference point. So once that you've seen that, where we are with the markets, you can clearly see that we have had multiple corrections, and you can see that here. This is Brexit. This was the big fallout on the oil side, junk bond side, and such rate fears back in January and February. A large W formation, which is a double bottom. A double bottom here, and a massive move up, and you see minor replications of similar patterns along the way, and it all depends how much you're zooming in and what your time frame is. But you had the same type of situation here back in May. You saw a complex head and shoulder here during Brexit, with the head down here, left shoulder, right shoulder, moving higher, moving in a very tight volatility band, which I kept on showing, and we actually made money. And remember, I just don't keep on showing things. We actually make money of these things. And then you get the big thump down on the 9th of September with all kinds of I call it rate exit, fear of the Fed acting quickly, fear of rates rising. then a bunch of heavy large candle consolidation days. And let me just zone in between Brexit and now, so you all can see that. And again, this is not the first time many of you are seeing this. I've covered this topic extensively, but it's always good to remind ourselves where we are. So you get this massive intraday volatility with a follow through that comes through, and then the market takes off, hits the downtrend line, backs off again, creates a reflex bounce, which we did extremely well on, and then you get that big fall off on Thursday on Deutsche Bank, and then you get the move up on Friday, which exactly hit the downtrend line as I structured this chart, and I've shown this multiple times intraday, and then now we have this minor reversal candle. Okay, so this is your daily final finish as of Friday as we enter the month of October. So you have this big downtrend line sitting here at around 2173. We went as high as 2175 as I projected and forecasted and made money on the SPX calls. We have an upper Darvas here at 2180. And we need to basically, to be realistic, we need to, there's a gap fill here. Upper gap fill is pretty much close to where we went, which is around 2177. See the axis on the side. And what we need to, in order for the market to rally further, let's say, we want to have a up week, you need to basically take out, with a large candle move, the 2180 level or so, and then go and engage the upper Bollinger, this blue line here at 2196. Once we get to 2196, it should be a follow-through burst towards 2206. Now, why are these things important? For some of the newer people who are listening to this video cast, they're wondering, why is he talking about the SPX so much? Well, that's the stage that you dance on. Okay, that's the stage that the stocks that you trade on dance on. Now, yeah, they could be in different sectors, say biotech and this and that, and every stock has its own sort of mind and motion, as I like to call it. But it is very, very critical from a trading standpoint, both long and short, to see what the S&P 500 is doing. We have been doing this for years now, and you all can see that the results have been pretty fantastic. And there are traders in here, including myself, who trade the SPX, RUT, and sometimes the QQQ quite actively. And that itself is a trading strategy, to basically just focus on the indices instead of trying to find the next best thing when it comes to stocks. Even though we have some great ones running, as you all know, and that's fine. So, bottom line, this upper Darvas at 21 is 80. I'm rounding off the decimals. Needs to be taken out, and then you get a fast burst up to here. This could happen. This could happen by the end of this week as we settle down for the inevitable, in my opinion, technical and seasonal pullback that we get towards the middle of October. Now, a couple of things here to keep in mind, and this is a daily chart. We are starting to see a weakening of the moving averages. If you look at this particular part here, you're going to notice that the 34 has crossed below the 50. The 50-day moving average is right there, the red one, the SMA. This is a simple moving average, not the exponential. And the thing is, that is kind of giving you an early warning sign that the market is softening. All right, so right there, I can see it visually just by looking at it that this is, this is starting to, that this is starting to somewhat curve down right there. Okay, so the bottom line is that, bear with me one second. Okay, so the bottom line is that if this downtrend line keeps on acting as major resistance, the market is going to roll over. You have multiple support levels. You have the lower Darvas. You have the moving average down here. You have a mid Bollinger with 2155. You have a lower Darvas at 2140. The ultimate uptrend retest, which also coincides, give or take, with the lower Bollinger, this blue line, and this powerful uptrend line, which has held supported Brexit, meaning the uptrend bounce, supported the massive fallout in the early part of the year, January and February. This line basically at somewhere around here, 2118. If it gets violated, you can rest assured that this market will fall. There's a gap here to fill at 2042. There are multiple lower levels to consider. Is it possible that the SPX goes and tests 2000 in the month of October? It is very possible. So when you look at that, I'm going to give you a figure because you got to multiply roughly 6 or 7 to each S&P point to arrive at a rough approximate Dow point. We're at 2168. If we get down to, let's say, 2000 to test the Brexit lows to see if this was a real low or not, okay? So you got 170 points roughly. You multiply that by 7 and taking the higher number, you're getting almost a 1200 point move on the Dow, which will bring us back to around 17,000. Do you know what the kind of headlines that's going to create? And that is going to be a pretty, let's put it this way, that is going to test the structure of the market, because anything below this, in my opinion, anything below the 1985, 1990 level, if it happens in the month of October or further out, is going to break the back of this rising intermediate bull market. Period. That's going to create a level of a magnetic attraction towards testing the 1800 level again. And of course, we should know that if we break 1800, we're looking at some real pain across the board. Well, let me just put it this way in the reality of things. Even when markets are down 40, 50, 60, 100 points just from a tactical reset, people are freaking out. Well, imagine how you're going to freak out if you're not positioned right, if you're not focusing on the charts, if you're not acting on my alerts, protective hedges and such, and we drop 1,200 points over a short period of time. Now, this rose 1,200 points from here. Why can't it test 1,200 points down here? That's how mechanics works. That's how algo HFT programs can decimate retail traders who are not focused on trading the technicals. Now, keep in mind that these things don't happen in one day. This took 1, 2, 3, after these 3 massive candle reversals we talked about extensively, the short squeeze, 4, 5, 6, 7, 8, 9, 10, 11, 12. It took a good amount of time, right? So let's do the math here. It's from June 27th till we reach the 21, almost 2200 level. It took roughly a little bit more than a month and a half. So a little bit more than a month and a half. Is it possible that by the November elections that we get down here? Absolutely. Absolutely. So get ready for some serious volatility. You cannot be sitting there twiddling your thumb wondering what to do. You got to take advantage of high momentum movers. Tesla is up 4% today on the back of the news that their deliveries are much stronger than expected, and this stock will probably climb a bit, probably climb towards that 220, 230 level that I've kept on showing for a while now. Now, those are for active traders, so you do what you need to do. In the meantime, we have a bunch of takeovers that are in play, and there's great IPOs like NTNX, which I showed at $26 and $27. It's closing into 39. Went to 39 actually on Friday, almost 40. NXPI, got a whole bunch of stuff. So stuff's going to keep on happening. That's going to be independent of what the market's doing. I just want to give you a broader picture. Now let's take a look at what's happening with the futures, because that is what runs the motions of traders as we get into a trading day. And you have to track futures because you just can't survive without it. Period. And I've talked about this extensively. So here we are back in that volatility stage. We have futures down about 6 1/4 right now. You can see that happening right here. So let's see what exactly is going on. In my opinion, this is where what we are trading in. We're trading between 2175 and roughly 2130. So if you look at this level, this range here, 2175, and then 2134, you're talking about roughly 40 points. So 40 times 7, you're talking around 250, 240 to 280 Dow points that the market's going to travel in. The faster we sell off here, this is the 1 hour stows you're looking at. Look what's going on with the 1 hour resets. It's starting to come down pretty fast, just on a 6.25, 6.5 point drop in the E-minis. And once it gets deep oversold, we know pretty much what happens. Once it gets around here, you get the inevitable sharp bounce within a matter of hours or within 24 hours. In this case, it happens within a matter of hours or the same day. So let's take a look at the 4 hour, which is very important to track too. You can see here that the 4 hour now has hinged, is curling down. This doesn't mean it's going to come down here to reset. You know, it could do this. It could come down halfway towards the 43 mark on the RSI stochastics. And remember, the stochastics are the first derivative of the RSI, or second derivative of the relative strength index. So, and I use it very, very effectively, and many of you do too. And I've taught them extensively on the advanced coaching sessions how to do this stuff in many different fronts. So here we are engaging. So it could very well come down here and then take a move up, do whatever it needs to do, possibly come down or move sharply higher. This candle to me signifies at face value that we are coming down. So if that's the case, the levels that the market needs to engage in, you have to look at it on screen. It's not rocket science, believe me, because I'm not a rocket scientist. Elon Musk is. So you got here's a 4 hour. So it's the closest thing to a daily that you can deal with. So you have the 50 retest happening right now in front of your eyes, right there, and right there. Okay, it looks like the size of the body of this candle, just by visual stuff, okay, is going to connect with 2152. So you'll see futures drop another 2 points right there. The orange line being the 34 SMA. If it breaks that, we are going to do a full-scale reversal back to the lower Bollinger that's at 2140. So it could be an opportunity to short depending on how the market reacts at the open. And I don't mean 5 minutes into the open, but let's say, within 15 minutes or so. When we look at the 4 hour charts, we can see here that's curling down. Looks like a reset is possible today. Now, 4 hour resets don't happen right away. They normally take a full day. So here we go, down 7.25. And you will always see background news. Deutsche Bank didn't reach a settlement and stuff like that to move these type of markets. So lower end of the band, 2140, 2133, upper end of the band, 2174 on the E-minis. You just have to add 5 or 6 points to it to arrive at the S&P number. So 2174 here is roughly 2180 on the S&P 500, like I showed on the previous chart. So that's a quick synopsis of what we can expect. You have to follow the daily dynamics on the 4 hour, on the 1 hour, which, by the way, right now is getting quite oversold. But if you can see from the pattern, if you want to specialize in pattern symmetry, you can see that there's a good possibility that we basically come down like this and create a bottom, come down, create possibly a double bottom, and another big rally which comes in the latter part of the week. All right, we'll see what happens. In the meantime, let's take a look at something interesting that I saw yesterday, which is more of a longer term picture. That has to do with Chipotle. Stocks generally have a 50% Fibonacci retracement. Okay, this is over years. This is a monthly chart going back to 2010, from where Chipotle was a cheaper burrito at 80, and then it went to almost 800. So here we are exactly at the 50% Fibonacci retracement level, and look what the stock is doing. It's holding that. We have a large falling wedge, which looks like it's breaking out. Once we break out over this pinched Darvas right here, I'm running out of time here. Okay, right there is your pinched Darvas. Use the Darvas box on your screens too. Once you break out of that, engage the 50 moving average. That's $506. It could very well be that we hit $506 by earnings, and that's a big chunk of money. And I'm not talking about scalping, 400% on lotto.